Hi, everyone. Welcome back to the ins and outs of selling a business. For those of you just joining us, my name is kdee. I'm President of Osage Advisors. Osage Advisors is a merger and acquisition firm which works with business owners and their families looking to sell. We've been around for over 20 years now, and we typically work with clients with $5 million in revenues and up. So I want to welcome back and continue our conversation about trends in the M&A market for 2022. In our previous episode, or part one of this podcast, we talked about coming out of a roaring 2021 M&A market. Historic volume, over $3 trillion in transaction value. Valuations were at an all-time high, plenty of cash, chasing deals around, which caused a significant competitive environment, which was, all great for our clients and business owners who sold their companies back in 2021. On the good news, in 2022, and looking at trends, there still is a significant amount of cash out there. I believe private equity still has close to $1 trillion looking to acquire companies that into their portfolios. Strategic buyers are looking for synergistic add-ons, as well as companies that could create new market opportunities for them, expansion of product lines, etc. But there has been a tap on the brakes that we talked about, where there's a number of factors in the current environment that have raised the level of skepticism among buyers, which frankly has had some effect on value. So, from a trending perspective, and some of the research we've looked at, and some conversations we actually had with buyers, we've seen valuations have peaked, probably have leveled off, and in some cases are down a bit. We talked to a equity fund who called us this week, and I asked him, I said, where you guys seeing value today? And he says, well, we've kind of dropped our offers by a half turn. What does that mean? I mean, if it was a company that $2 million in adjusted profits and we were paying a 7 multiple for at 14, now we're looking at maybe paying a 6.5 multiple, or if I did the math right, 13 million. So I think sellers need to be prepared for looking at transactions today, where we're going to add some we call structure to the deal. So instead of being all cash at closing, it may be, hey, we believe you can get there, but you got to prove it to us. So for the transaction I just gave you an example of, said we're willing to pay you the 14 million, but we'll pay you the 13 today based on the current environment. And if you produce and hit those numbers in the next 12 to 24 months, we're happy to pay that extra $1 million or $2 million, whatever it is, and what we call an earnout. But you need to perform. So typically that means that you as the owner will likely stay on, or someone within your family will likely stay on with the business to kind of drive the leadership of the company to work towards hitting those targets so you get that final payout. We saw a lot of this at the beginning, coming out of the pandemic in the first quarter, I would say the third quarter of 2020, where deals were being structured in a way that, hey, we're not sure where we're going today, but we want to do a deal. You want to do a deal. So let's put into place a structure that makes some sense for both of us. So those are trends we're seeing. We recently closed 2 deals where one of them was full payout at closing because of the nature of the company. The other one, there was an earnout component to it because they had a contract that was delayed by one of their major customers, but was just kicking back in. And the buyer said, and most buyers are reasonable about this, or actually they want you to hit the numbers, right? Because they're buying you and they only increase their value. Is say, look, we get it. So if you hit that number and a business is back, we're happy to pay you out. It's a win-win for both companies, because if you hit the number, one, you get the full payout and your family or your partners get the payout. And two, from a buyer perspective, they want you hit the number, then the value of that company goes up, which creates greater value for them and their whole portfolio of businesses. So you're trending moving forward. I think we're going to see structure come into it, because we're really not sure where things are going. I mean, right? So like we talked about earlier, you got supply chain issues, you got inflation, rising interest rates, geopolitical issues and no one knows kind of where we're headed. And of course, we could be headed into what we call a recession. I mean, a lot of us feel we're already there, but it hasn't been acknowledged or designated by any group as such that I'm aware of. So those are one issue. So, another issue I think we talk about is that relates to the supply chain when we're looking at structure, which is really become more prevalent, is that especially if you're if you hold inventories, so distribution, manufacturing, industrial type companies, as we mentioned, that you're holding unusually high levels of inventory right now to meet your customer demands. And you're also procuring product from not only your existing vendor base, but you're probably reaching out to vendors you haven't really dealt with in the past. So it's a new relationship, and can they deliver? So you're looking out, instead of 3 to 6 months, you're now looking out close to a year. We sold a company last year that, because the supply chain has been through 2021 and obviously continued 2022, where our client was looking to procure product 9 months out lead times versus a typical 60, 90-day lead time. So what does that do? That puts more inventory in your balance sheet, which you have now tied up versus being in cash. And so when you sit down and you negotiate the working capital component of a transaction, it's somewhat skewed today, because historically my inventory is $5 million, but I have $8 million of inventory on my books. I should get credit for that in the purchase price. That's the business owner's perspective, rightfully so, right? And we defend that point, and we can back it up. A buyer's going to look at it and say, well, look, I understand you traditionally had $5 million of inventory. Now you have $8 million, because if you didn't have $8 million, you couldn't produce the product you needed to get your sales and EBITDA where they are today. So you got two ends of the spectrum, from the buyer and the seller. So you need to come to a happy or agreed upon metric for what that working capital component is going to be. In the past, I would say pre-pandemic, it was a fairly straightforward calculation. Obviously, you adjust for seasonality depending on the business, but hey, my last 12 months working capital was X. At closing, it's X, no adjustment. We move forward and everybody's happy. You throw a pandemic year in for 2020, you come out of it into 2021 and you have supply chain issues running into 2022, and you're skewed. I mean, your inventory numbers are not historical. They're changed to current market, but you want to get credit for that. So, from a buyer-seller discussion, it's a little more complicated than it used to be. So I think, running those numbers, justifying your position, so you have your internal team, controller, CFO, et cetera, run it. Have your external CPA firm take a look at it, and then let's justify why we should get this credit at closing to produce more cash to you in your pocket at closing. It's definitely going to be a what I wouldn't say tense conversation, but certainly a meaningful conversation. But I think it's important to be transparent about it. I think you need to bring it up early in the discussions when you're in the due diligence process, so that the buyer's aware of your position, so that you work through it to everybody's satisfaction, and it's not sitting there at the end of the transaction and kind of could possibly blow up the deal after you spend all this time, energy, and money. So from our perspective, we'd like to get that working capital discussion going on early once we're in due diligence, so that we can come to a meeting of the mind, so to speak, between the buyer and our client. That that's a reasonable approach. And we'll find, we'll as we go through our due diligence and check it out. But that formula and your support for running that calculation makes sense to us. So you don't want to leave it to the end. You want to bring it up forthright. So those are the kind of things that we're seeing that are going to be from a structural deal moving forward. I think we're going to see some. I need to be creative in getting deals done from that perspective. Other thing is, I think you look at the type of buyers out there right now. I mean, I think there's a lot of financial buyers chasing deals, have been for many years, but certainly leading the charge out of the pandemic. And the notion today that a strategic buyer is always going to pay more than a financial buyer. I mean, I'm not so sure that's the case anymore. I mean, there are reports out there that delta has shrunk significantly. So when you're talking to, and that's why it's important to, really is to talk to multiple parties at the same time. That's to get a balance of strategic buyers and equity funds at the table in a competitive environment like Osage does, so that you can, kind of read the room and where they see value and how they're pricing the deals, so you can make the best choices for yourself. I mean, for example, you can pick up the phone and it's one of your competitors, or someone has a similar product line from a different part of the country, and your mindset says, hey, this is a strategic buyer. They're always going to pay more than a financial buyer. I'm going to have a conversation with them. That's not necessarily the case today. A lot of that has been built by what I would call, equity funds have grown significantly from 2001 when we first started. I think there was maybe 1,000 private equity funds. Now there's over maybe 5,000, 6,000, 7,000 equity funds in the country. They all have portfolios. So in a lot of natures, they are strategic by the fact that they're going to roll you into or bolt you onto or to one of their investments that's in and around your business. So it is strategic to them. So I think you got to be careful, and I think you got to be open-minded about what having choices, talking to various funds, what they bring to the table. Moving forward, I'm sure your phones are ringing. There's a lot of lines going out there. I have a client that sent me an email, a copy of a letter he got from a private equity firm. It almost seemed like it was personalized to him, right? And you read through the letter, and you get to the last paragraph, and it says, if you have, 10, 20, $30 million in revenue, we'd like to have a conversation. So it's almost like a personalized letter, which is really a form letter that's been bolted out or blasted out to maybe, 500 companies or 1,000 companies or 2,000 companies. And they're trying to get, it's a numbers game. They're trying to get conversations going on with, half dozen or 10. So they're just trying to get out there and find companies to have a conversation with. So, we've always talked about early on, if you pick up that phone and you start having that conversation, I mean, who are you really talking to? I mean, do you really understand what their motivations are, what their goals are, what they're trying to achieve, and do they align with yours? Or are you going to, drive the process with an advisor such as Osage or one of our competitors out there that's going to kind of make sure that we bring high qualified buyers to the table, vet them so that you can have meaningful conversations with people that have a significant interest in your business. Because, again, today we are in, kind of, stormy weather, stormy waters between, trying to manage your supply chain, your bank, of course, with, managing your lines of credit, your interest rates going up, inflationary pressures, probably most important, number one, labor, keeping your people happy, finding people, getting distracted by something over here that is important, but takes you away from managing your business. It may not be the best use of your time during this environment. So, what we're seeing is that the buyer community is very active. The trend is they'll remain active. They're sitting on a ton of money. And they will be, the phones are ringing. And not just the buyers, but the financing sources. I mean, if you go back to 2008, and we had like I think we had two deals that were ready to close before the big kind of crash, the Great Recession 2008. The reason why the deals didn't get done was not because the buyer and the seller didn't want to do. They didn't get done because basically the financing just stopped, dried up. The banks put a full stopped lending at that point. We're not in that environment today. Maybe the cost of capital is up, but as I said earlier, we were at a conference a few weeks ago, and there was a number of lenders there, and they're looking for deals. They are really hungry. They're sitting on a lot of money. I mean, if private equity is sitting on $1 trillion, the banks are sitting on $3 trillion, looking to deploy the capital. So the banks are still willing to lend. They want to lend. Obviously, the fundamentals got to make sense, but the money is out there and available. So the trend in the market is going to be what I say, there's certainly a slowdown in the marketplace, but if you are a high qualified company and you're looking to sell, it's still a good time to go to market because the competition is still very healthy. There's still a lot of cash out there, but prior to going to market is really important to make sure that you have ask and answer yourself a lot of questions. A buddy of mine uses, do a full CAT scan and MRI in your business, right? And it's a good analogy. I mean, really to sit from the top down and to make sure that I ask myself these questions. If I was looking at this business, what would I want to know? And if I have the answer to that, that's great. If I don't have the answer to that, how am I going to come up with the answer to that? Because it's critically important. You don't want to get into a prolonged due diligence process, 60, 90 days, with a potential buyer where these questions are going to come up. As I said earlier, the skepticism meter is high. So the buyer is doing a much deeper dive, not only into your financials, but into various aspects, right? They're looking at your operations, looking at your human resources, looking at your purchasing, your procurement, they're looking at your cybersecurity, they're looking how your company presents employees, your retainage, how you're hiring, how you recruit, what you're paying competitive to the market. They're looking at your social medias, they're looking at cybersecurity. The list goes on and on and on. So instead of having 3 or 4 streams of workflow to do due diligence, now it's 8 or 10. So that takes time, that takes money, that takes energy on both sides. So being properly prepared is always important, but in what I would call uncertain times, where you really can't get a visibility on where things are a year out from now, it's even more critical. But as an owner, if you're still in a good position, there's still buyers for your business. It's just really preparing yourself properly. And I can't emphasize that enough. I mean, I always kind of take the contrarian opinion, is that when things seem the worst, they're the best. And it is competitive. There's a ton of money out there. Strategic buyers and financial buyers are aggressively out there looking for deals. They've cast a wider net than they typically have. The question is, don't get caught up in that net, right? Time the market, test the market the way you want to, drive the process the way you want to get it through over the goal line that's best for you and your family. Those are the critical things that are important in today's climate. So, with that, I want to thank you for participating in our podcast today. My name is kdee. I'm President of Osage Advisors. You can learn more about our firm on our website at osageadvisors.com. Feel free to call me anytime at 860-767-3273, extension 1001. Happy to answer any questions you may have, give you a sense where the market is today, where we think it's going tomorrow, or shoot me an email at kdee@osageadvisors.com. Thanks again for your time, and have a great day.